All right, everyone. Well, good questions so far with the introductory part. I want to take us now to our little mini class. So with that, I want to talk to you a little bit about a topic that I teach in our CFA program, and that's the financial reporting and analysis material. If you remember from our little introduction, I showed the weightings of the different topic areas on the exam. Financial reporting and analysis for the 2019 edition of the test carries a 15% weighting, which ranks it as the most heavily weighted topic on the level 1 exam, tied with ethics, a very different topic, one that students tend not to love, but very, very important to passing the CFA exam. But we're going to focus on financial reporting and analysis, also known as the accounting material. So I've prepared for you all a little mini discussion, a little mini class that's going to start with the very first of the core financial statements that we discuss in our financial reporting classes, and that's the income statement. So we're going to take a little walk through the income statement here, and I want to take a flash through now to our slide presentation and take a look here at the setup of the income statement. So you can see at the very top, you got your revenue, subtract from that some cost of goods to be able to get down to a gross profit line. Then you've got the SG&A costs there. You can see these are your operating costs to get to an operating profit, or also known as an EBIT, earnings before interest and tax. Other revenue or income could be from earning some interest or dividend income on some excess cash that you've invested. Financing costs, also known as interest expense, would be paid on the debt that you carry on your balance sheet. And then you get down to this kind of funny item called unusual or infrequent items. What do we do with that? How do we deal with it? And what we need to understand, if that ever appeared on an income statement that we're analyzing, is what's in there. What do they have in there, this unusual or infrequent items? So we could be a manufacturing company, let's say, that sells a building, sells a factory, sells a piece of equipment, maybe even that was being used in the factory. And that sale might generate either a gain or a loss compared to the value that we carried that equipment on our balance sheet for. So that gain or loss on the sale of an asset would fall into that category. Now that's one example. We could have other examples as well. We could have issues with maybe having to rework one of our factories because the environmental regulations have changed and we're going to need to put, let's say, an air filter on the factory to be able to make sure that it doesn't pollute the air any longer. That additional cost, kind of an unusual or infrequent item, would fit into that category. So we got to, again, understand what's going on in there. And then the other thing we have to make sure of is that the company that uses that line isn't trying to put operating expenses in it, but instead is truly using it for its intended purpose and only including unusual or infrequent items. That'll bring us down to the bottom of the first slide, which is the earnings before tax. Then you can see this provision for income taxes. So what we're doing here is calculating an expected tax expense based on this pre-tax profit. And from there, we would then we'll take a look at the earnings that we're generating from the continuing operations of the business. And then after that, if the company has any sort of operations that they've discontinued during the year, that could be selling of a business segment or even just the intention to sell it, you're going to put the gain, or excuse me, the income or the loss from that discontinued operation into that final line there before you get down to the very bottom, the net income. So that's a little bit of a walkthrough of the income statement. Now in a class, we would open this up even further and talk a little bit about the different line items within. The very, very first line here, revenue or sales, very important. We want to look at how does a company get to recognize revenue at the top of an income statement? How does the sale actually become an item up there at the top? So just think at a hypothetical, for example. Let's say that you all become CFA students of FK Partners in 2019. And some of you, let's say the ones that don't win the 100% bolsa from performing the best on the test tomorrow night, pay something to FK Partners to take the course. Well, let's say that some of you all paid us in advance before the course began. Well, FK Partners would receive some cash from the customer But since the course is not yet started, FK Partners is not going to be able to book revenue associated with that payment. They're going to instead have a liability on the other side of their balance sheet. So they'll have cash on the asset side that came in from the customer, and then a liability associated with what we call deferred revenue. Revenue that we cannot yet recognize because we haven't delivered the service. Now, as the course begins, and as the student starts to make his or her way through the different classes, we're going to be able to take some of that revenue, that deferred revenue, I should better say, and recognize it up at the top of the income statement as actual recognizable revenue. And then as we go all the way to the end of the course, and we've completed the entire, all the classes, the last mock test, we take the test, everything's done, we're going to be able to recognize all of the payment as actual revenue on the income statement. So it's very important that when we're thinking about the concept of revenue, it's not a cash basis accounting that we're thinking about here when we study the CFA curriculum. A lot of you that have familiarity with accounting might understand the difference between accrual accounting and cash-based accounting. If we're using, like most companies do, an accrual-based measure, we're only recognizing revenue when the company actually provides the product or the service that was contracted by the customer. Now, if it's a product sale, it's a lot simpler to visualize. So if you were to go into the store and buy a camera from an electronics store, and you pay and you walk out of the store with the camera, well, that's easy. You've given your consideration, the price of the camera, to the vendor, and you've left with the good, the product. The risk and reward of ownership of the product is transferred to you through that sale. You walk out, you go home, start using the product. But if it's a service contract, I gave the simple example of the CFA prep course, but if it's a service contract, things become a little bit more complex. We have to determine how long the service is going to be provided for, and we can basically use an assumption in terms of how much revenue we can recognize based on what percentage of the service that has been provided from the seller to the buyer. So these are just some of the techniques that we're going to explore a little bit more as we dive into the income statement accounting in our CFA prep course. Now, another very, very important concept as you work your way through the income statement would be understanding how to recognize expenses. Now, if you take a look at this slide here, we have two categories of expenses: accrual-based expenses that require us to use what is called the matching principle, and what we call period expenses. A period expense, just to start there, is simpler to conceptualize and to account for. A period-based expense would be a lot of your administrative costs. They don't directly match up with the timing of revenue events. So let's say that we rented a space, an office space for our company, and we signed a contract in which we will pay a monthly rent to the owner of the office building. Independent if we sell lots of goods or services in the month of November, or we don't sell anything, we still have to pay the rent. Thus, we would consider that rent a period cost. Now, the accrual-based expenses that you can see towards the top of the slide would include a number of different other items. Inventory shifting from the balance sheet to the income statement into what's called a cost of goods sold line would be a great example. So let's say that, back to the other example, we're selling cameras. We're at an electronics store. And when the customer comes in and purchases the camera, in addition to recognizing the revenue, the sale price for the camera, we also have a cost on our own balance sheet for that camera. Now, likely, since we're in the business of making profit, we're going to have sold that camera to the customer for a price that's higher than our cost. Now, when we do that, it's going to trigger a movement of that camera from the company's balance sheet, inventory line to be specific, to the income statement into the cost of goods sold line. So you're matching, as you can see, a revenue event with an expense. Now, you can see there's some others up there. I won't go through all of them, but let me just throw another one out there. Warranty expense. I'm using this example of the camera. If you go and buy a nice digital camera at the electronics store, you want the thing to work for the next several years. you don't want it to break over the next couple of months or the next year even. You want it to work for a long time. Likely, when you make that purchase, you're already going to be looking for what we call a guarantee agreement or a warranty associated with the purchase of your product. And for that reason, the seller needs to account for that warranty or guarantee agreement as an expense at the time of sale. So let's say that we sold this nice digital camera to our customer for 500 reais. And we told the customer through a written guarantee agreement that if this thing breaks down sometime over the next 2 years, you have a right to bring it back to me and you'll be able to get it repaired or even replaced if we're not able to repair it. Now, we know that when we sell thousands of cameras throughout the year, not everybody, in fact, most will not see their cameras break down and need to be repaired over the next couple of years. But some will, and for that reason, we're going to already take a percentage of the revenue based on these historical trends and book it as an expense, a warranty expense, at the time of sale. We're already accounting for this based on, you can see, the matching principle of accounting. We don't want the readers of our financial statements to think, I sold a camera for 500, it cost 200, all 300 difference is a profit. Maybe not, because if it breaks down and we have to spend another 100 to repair it sometime over the next year, then that's another expense that was associated with that sale. So we're going to need to understand, again, how to categorize expenses into these expenses that would fit into that matching against revenue events, and others, like those period expenses, like the rent, that don't. So beyond the revenue, as we work our way down to the expenses, we'll eventually reach the very bottom. And this is where we get into the profit, the income. Now, one of the key concepts on the level 1 exam is understanding how to account for earnings on a per share basis. So we're looking at the amount of income or earnings that the company is able to generate in a given period from the perspective of a shareholder, an owner in the business. So not only are we looking at the big picture overall number of net in terms of net income, we want to look at it compared to how many shares of stock the company has outstanding. So we're going to look at that net income relative to those shares in circulation. So if you take a look at the formula up here for this earnings per share calculation, you have the earnings that are available to the common shareholder. So that's a net income slightly adjusted for any preferred shareholders, which is a topic we won't get into tonight, over the number of shares of stock that are outstanding. Now, there are 2 calculations that a CFA level 1 candidate will need to know how to deal with when it comes to earnings per share. You can see that towards the bottom of the slide, a basic earnings per share calculation and what we call a diluted earnings per share calculation. Now, the difference is the basic's pretty simple. It's all the shares in circulation, okay, divided into the earnings number. The diluted one includes all the basic shares that are in circulation plus any potentially dilutive securities. And for our test, you're going to need to understand the concept of these potentially dilutive securities. Now, if you take a look at the list of potentially dilutive securities, you have stock options and stock warrants. These are rights that the holders of these options or warrants have to purchase new shares of stock at a fixed exercise price. If the company issues these options or warrants to employees, let's say, that they want to incentivize to stay with them over the coming years, we need to account for that in the calculation of earnings per share. Reason being, let's say that we issue a bunch of stock options to our key employees, and over time they start exercising these options. These exercised options are going to create new shares of stock. That's going to increase the number of shares in circulation, and it's going to, all else equal, decrease the earnings per share. So we have to go through and test to see if the options, warrants, or some of these convertibles, debt or preferred stock, are actually going to dilute the earnings per share number. Notice that the list is called potentially dilutive securities. It doesn't mean that they actually are dilutive. In the case of a stock option, for those that have familiarity with the subject, a stock option that is in the money is considered dilutive. How could that be? Let's say that we issued earlier in the year 2018 to the key employees stock options with an exercise price of $20 each. And now the stock price is $30. That gives that employee the right to purchase shares from the company at $20 when the actual market price is more. So the company, the shareholder, the option holder has a great deal. The option holder can pay 20 and receive something back that is worth 30, a share of stock. The guy could turn around and sell it in the marketplace tomorrow, or he could hold on to it for the foreseeable future. But he's got an in-the-money option that needs to be accounted for when we're doing this earnings per share calculation. Now, they have that same example. Option issued to the employee at the exercise price of 20 is not in the money. Let's say that the share price fell since that time from 20 down to 15. The guy is not going to pay 20 to receive something back that's worth less than 20. So in the case that the option is out of the money, we're not going to include it at all. That's why, again, at the title of the slide that we looked at earlier, you could see the list of potentially dilutive securities. It doesn't mean that they automatically will dilute the existing shareholders. They could, but they might not. And that's why we have to test each time to determine if we're going to include these potentially dilutive securities in the calculation for earnings per share. So I want to go through with you all one of those calculations here tonight so that you can get an idea of how these actual questions are formulated on the CFA exam. So let's take a look at a stock option question. Now you have a method, which is called the Treasury method for accounting for stock options, that we're going to walk through, which is a 4-step process. But let me flash up here for you all a slide that shows some numbers around the example that we're going to be doing. So I'm going to just read for you all this slide. You have earnings right now of 1,200,000. You have a number of shares outstanding of 500,000 shares. You, in addition to that, have stock options that are outstanding that would potentially increase the number of shares outstanding by 100,000, meaning you already have 500,000 shares outstanding. You could have another 100,000 shares outstanding if all of these people that held those options actually exercised them. That would move the number of shares up from 500 to 600,000. You can see the terms of the option. Exercise price is 15, and what is going on with the market? The market price is 20. So what we want to do now is run through a basic calculation for the earnings per share. So you have, like I said, a calculation for the basic EPS, which would be, I'll write it up here. The earnings number, 1,200,000 over the 500,000 shares outstanding. So this is going to give us a basic earnings per share number of $2.40. Now, as we saw, there are 100,000 options outstanding, and you have an exercise price on the options of $15. In addition, we saw that there's an average market price for the actual shares of stock of $20, meaning that the exercise price for the options is less than the average market price. That means that we have in the money stock options. And for that reason, we can check the box and say, these actually are dilutive. We talked about potentially dilutive securities. Well, these 100,000 options are no longer potentially dilutive. They actually are dilutive. Again, reason, exercise price is less than the average market price. So now we run through a process that we call the Treasury method for accounting for stock options. This is a 4-step process that first involves looking at how many potential new shares are there. And since all 100,000 of these options have the $15 exercise price, all 100,000 are potentially going to roll into the share count. Now, the second step would be to say, all right, now if the employees actually do exercise these stock options, they don't just get shares of stock for free. They actually have to pay something. What do they pay? They pay $15 per share. So we're going to need to calculate now the proceeds that the company would actually receive if those employees exercised their stock options. So we're going to take 100,000 shares multiplied times that $15 exercise price to calculate 1,500,000 in proceeds that employees in aggregate would pay to the company to be able to have the right to receive those shares of stock. Third step, once we calculate the proceeds, we're going to calculate how many shares the company can repurchase with those proceeds. So remember, we don't like dilution. There are 500,000 existing shareholders out there. There's 1,200,000 in earnings. That equates to this basic $2.40 of earnings per share. We don't want to add all 100,000 of these shares to the denominator, because then the number is going to go all the way from $2.40 down to $2 even. So we want to figure out a way to try to minimize the impact to the denominator increase. So we're going to take the shares, the proceeds, I should say, from the exercising of those options, and we're going to repurchase as many shares as possible at the average market price. So we're going to share repurchase here using proceeds. You can see 1,500,000 in proceeds over the average market price. What we can actually go into the market and buy for is going to allow us to repurchase 75,000 shares of the potential 100,000. So instead of having to add 100,000 here, we're going to have to add only the difference between the potential new shares and what we were able to repurchase, which is, by the way, the final step in our Treasury method for accounting for stock options. So we're going to take the first step, the potential new shares, step number one, which is that 100,000, and we're going to subtract from it the shares that we're going to repurchase. Okay, which is the 75,000. Okay, that's step number three. That's going to give us a net number here of 25,000. So step four is calculating, I'll write it over here, the net new shares that will be added to the shares outstanding. Now remember, we already started with an earnings number of 1,200,000 and a basic earnings per share number of 500,000. Basic shares outstanding of 500,000 to get to an earnings per share of $2.40. Now to calculate a diluted earnings per share, I'm going to erase a little bit up here. Diluted earnings per share. Okay, I already have my 500,000 shares outstanding, and now I'm adding to this the net new shares that I calculated through that method I just worked through. That's going to give me a denominator down here of 525,000, and that's going to allow me to calculate a new earnings per share number, diluted now, of $2.29. Remember what it was. It was $2.40. Now it's down a little bit to $2.29. So by doing this work, we're going to work our way to understand a more conservative estimate for the number of shares outstanding. So again, we looked at just purely income over shares. Now we're looking at income over shares plus what would happen if employees actually exercised their in-the-money stock options. So this is giving you a little taste, a little example, everyone, of some of the material that's going to be explored in much more depth in the financial reporting and analysis part of the CFA Level 1 curriculum. Very important concept. So overall, if you remember from, again, our little review of the topic weightings, 15% of your CFA Level 1 exam is going to be comprised of these financial reporting and analysis questions. That means that out of 240 total questions, you're going to get 36 financial reporting questions. All right? Of those 36 questions, you're going to probably have 3 or 4 questions that deal with the concept of the earnings per share, whether it's calculating a number of shares outstanding, a diluted earnings per share based on stock options, maybe a diluted earnings per share based on convertible debt or convertible preferred stock, and then even exploring other topics that we just touched on earlier tonight about revenue and expense recognition. We could add even another couple of questions to the mix in terms of exploring the overall income statement. So income statement, then followed by the balance sheet and then the cash flow. Very, very testable topics here for the financial reporting part of your Level 1 exam. Beyond that, we get into ratio analysis. We dive deeply into inventory accounting, long-lived asset accounting, income taxes, the concept of debt accounting from the perspective of the borrower, and then we get into lease accounting and even pension accounting towards the end of the curriculum for financial reporting Level 1. Lots to explore here. Very, very heavily weighted, relevant topic for the test taker here at the first level. And it's something that we need to, as Level 1 candidates, to take very seriously if we're going to have a chance of passing this test. So why don't I pause now and see if there are any questions from the audience about, first, anything really that we're just discussing here, or any other topics about CFA in general. So I'll leave it all to you now to type into the chat if you have a question about tonight's discussion.